Before we dive into the numbers, I want to ask you something important. If silver suddenly surged to $88 per ounce and kept climbing, would you recognize the reasons behind it, or would it feel like another confusing headline on financial television? Take a moment and tell me in the comments where you're watching from today. Which country or city? This discussion is reaching people from every corner of the world, and the reason that matters is simple. The forces shaping the silver market right now do not care what currency you hold or which time zone you live in. They affect everyone equally. What is happening in the silver market today is not random noise, not a lucky spike, and not a temporary media narrative. It is the result of structural pressures that have been building quietly for years and are now colliding at the same moment. Silver trading near $88 per ounce is the visible outcome of that collision. And the surprising part is that many commentators still cannot explain why the move happened. If a microphone appeared in front of them, most would hesitate, mention inflation or tariffs, maybe say that gold went up first and silver followed, and then quickly shift the conversation to whichever technology stock is trending this afternoon. But that explanation misses the deeper reality entirely. The move in silver is rooted in measurable supply shortages, relentless industrial demand, currency shifts, and technical structures that have been aligning for months. What we are witnessing is a mathematical consequence of those forces converging. To understand the scale of the move, consider one simple statistic. Over the last 12 months, silver has rallied roughly 170%. Just 1 year ago, the metal traded near $32 per ounce. Today, it sits around $88. That kind of change transforms portfolios dramatically. Someone who placed $10,000 into silver 12 months ago would now be holding a position worth about $27,000. Anyone who purchased physical silver bars during that time would see their holdings valued at nearly 3 times the original purchase price. Yet the most important point is not how far the price has already traveled. The crucial point is that many structural indicators suggest the move may still be in its earlier stages. To understand why, we have to begin with the foundation of every commodity market: supply. The supply situation in the silver market is not based on speculation or opinion. The data comes from mining reports, geological surveys, the Silver Institute, and the London Bullion Market Association. These sources track how much silver is mined each year and how much is consumed. The numbers reveal something remarkable. The global silver market is on track to record its 6th consecutive year in which consumption exceeds production. 6 years in a row, the world has used more silver than it produced. Every year, that gap must be filled by drawing down existing stockpiles stored in vaults, warehouses, and dealer inventories. Last year alone, the deficit reached approximately 95 million ounces. That means 95 million more ounces were used by industry, investors, and manufacturers than were mined out of the ground. In some earlier years, the shortage was even larger, exceeding 140 million ounces. When you add these deficits together across 6 years, the total shortfall reaches hundreds of millions of ounces. Those missing ounces once existed as bars sitting in vaults or inventory held by dealers. Today they are gone. Much of that silver has been permanently used in manufacturing processes. It has been soldered into electronic circuits, embedded into solar panels, dissolved in medical equipment, installed in industrial batteries, and integrated into countless modern technologies. Once silver is used in many of these applications, it is not economically recoverable. Recycling it would cost more than producing new metal. As a result, the above-ground stockpile shrinks year after year. This raises an obvious question that surprisingly receives little attention in mainstream discussions. If the world continues consuming more silver than it produces, where will the replacement supply come from? Global mine production reached its peak near 900 million ounces in the middle of the previous decade. Since that time, production has been mostly flat or slightly declining. Even though silver prices climbed dramatically from around $15 years ago to the current levels near 88, the mining industry has not been able to increase output meaningfully. The reason lies in how silver is produced. Approximately 70% of global silver production is not mined from dedicated silver mines. Instead, it appears as a byproduct when companies extract other metals such as copper, zinc, or lead. When miners dig for those base metals, small amounts of silver are recovered during the refining process. That means silver production is tied to the economics of completely different commodities. If copper mines slow down or zinc production declines, silver supply falls as well. Primary silver mines, where silver is the main product, are extremely rare. Only a small number of large operations exist across the entire planet. Developing a new mine is also an incredibly slow process. Exploration, environmental approvals, financing, and construction often require 7 to 12 years before the first ounce is produced. Even if mining companies suddenly decided to prioritize silver above everything else today, new supply would not arrive until the early part of the next decade. While supply struggles to expand, inventories have been shrinking rapidly. One of the most closely watched indicators is the amount of silver registered in the Comex system, which represents the metal specifically available for delivery against futures contracts. A few years ago, those inventories exceeded 150 million ounces. Today, the registered supply has dropped below 30 million ounces. That represents roughly an 80% decline within only a few years. Similar patterns appear elsewhere in the global market. Vault holdings tracked by the London Bullion Market Association have been falling for many months. The Perth Mint in Australia has reported the lowest silver reserves it has seen in more than a decade. Dealers around the world describe increasing difficulty obtaining physical metal for customers. Several well-known refiners and retailers have even suspended certain sales because they cannot reliably source inventory. This type of disruption is extremely unusual. Comparable shortages were last seen during the intense panic that occurred several years ago when global supply chains were temporarily frozen. Before that, similar conditions were rare and occurred decades earlier. When you combine all these elements together, the picture becomes clear. 6 consecutive years of deficits have drained stockpiles that took decades to accumulate. Mine production has not increased despite much higher prices. Inventories available for delivery have fallen dramatically, and physical dealers are reporting shortages. That is the current supply landscape, but supply alone does not explain everything. The other half of the equation is demand, and the demand story is even more powerful. Silver possesses a unique property that makes it indispensable in modern technology. It is the most electrically conductive element known to science. No other material conducts electricity with less resistance and less energy loss. Not copper, not gold, not aluminum, and not any synthetic compound developed so far. In a world where electricity powers nearly every device and system, that property makes silver extraordinarily valuable. And the global economy is moving rapidly toward electrification. Consider solar energy first. Every photovoltaic panel installed anywhere on Earth requires silver in its electrical contacts. The solar industry consumed roughly 140 million ounces of silver in recent years. That single sector alone represents about 15% of annual global mine production, and the expansion plans for solar energy are massive. Energy agencies project that solar installations could double within the next few years and potentially triple before the end of the decade. If that happens, the amount of silver required by solar manufacturers could climb toward 300 million ounces per year. One industry would then consume more than 1/3 of the world's annual silver supply. And solar power is only one part of the story. Artificial intelligence infrastructure and massive data centers represent another rapidly growing source of demand. Technology companies around the world are investing enormous sums of money into building facilities capable of processing the immense computational loads required by modern AI systems. Each data center contains thousands of electrical connections, processors, cooling systems, and power distribution networks. Silver appears throughout these systems in solder, conductive paste, and specialized connectors. As computing power grows, the electrical density inside these facilities increases, and that increases the amount of silver required per megawatt of capacity. This emerging demand curve is rising rapidly while the supply curve remains constrained. Electric vehicles add yet another layer of consumption. Every charging station, battery management system, and electric motor controller uses silver components. Even the vehicles themselves contain small quantities of the metal inside their electronics and power systems. A typical electric vehicle may contain between 25 and 50 grams of silver depending on its design. As global EV adoption accelerates toward tens of millions of vehicles each year, that translates into millions of additional ounces of annual demand. Defense technology introduces another factor rarely discussed in public reports. Advanced military equipment, including guided missiles, radar systems, satellites, and communication devices, also relies on silver within its electronics and batteries. When these systems are used or destroyed, the silver they contain is permanently lost. Much of the data regarding military consumption remains classified, which means official demand statistics likely underestimate the true amount of silver being used each year. When all these demand sources are placed alongside the shrinking supply picture, the imbalance becomes obvious. Consumption continues expanding across multiple industries, while production struggles to keep pace. This imbalance forms the foundation behind the dramatic move in silver prices, and it sets the stage for everything we will examine next. Another major force amplifying the silver market right now is the behavior of the United States dollar. Silver is priced globally in dollars, which means the strength or weakness of that currency directly influences how expensive the metal appears to buyers in other parts of the world. When the dollar weakens, silver becomes cheaper for investors and manufacturers using euros, yen, rupees, pesos, or any other currency. That lower effective price stimulates additional demand internationally. Over the past 12 months, the dollar index has declined significantly, dropping roughly 12% from its earlier levels. Currency traders have pushed their expectations even further, creating the most bearish positioning against the dollar that the options market has ever recorded. That level of pessimism toward the currency rarely occurs unless large institutional investors believe monetary conditions are shifting in a major way. Central banks have also contributed to this environment by easing financial conditions. Interest rates around the world have been reduced by several hundred basis points since the tightening cycle peaked earlier. Lower interest rates reduce the opportunity cost of holding precious metals because silver does not produce interest payments the way bonds do. When yields fall, investors often look toward tangible assets that can preserve purchasing power. At the same time, credit spreads in investment-grade markets have narrowed dramatically, indicating abundant liquidity flowing through the financial system. Historically, periods defined by easier monetary policy, weakening currencies, and abundant liquidity have been highly supportive for precious metals. Nearly every major bull market in gold and silver during the past half-century began under similar conditions. Those macroeconomic dynamics form a powerful tailwind behind the fundamental supply and demand picture already developing. Beyond the macro forces, technical structures in the market are also sending signals that many traders monitor closely. Technical analysis does not guarantee the future, but it helps identify areas where probabilities shift based on historical behavior and mathematical relationships in price movement. One framework used by analysts tracks mean reversion zones where markets historically tend to return after becoming too stretched in either direction. Within that model, the average equilibrium level for silver recently appeared near $83.80. The market currently trades above that level, which indicates that upward momentum remains active rather than fading. The next resistance cluster appears slightly higher, near $88. That area represents a point where sellers sometimes emerge because prices have moved far enough above equilibrium to attract profit-taking. However, if the market holds above that resistance, another level becomes visible around $91.63. That zone represents the next mathematical barrier where price reactions historically occur. What makes these levels especially interesting is that they align with projections from completely different analytical methods. For example, the geometric square of 9 model, originally popularized by W.D. Gann, identifies harmonic rotations in price. When analysts apply that structure using the recent low near $78 as the pivot point, the next rotational resistance levels appear near $91, $95, and $97. When two independent analytical frameworks highlight the same price zones, traders often refer to that overlap as confluence. Confluence does not guarantee that the market will stop or reverse at those levels, but historically it increases the probability that a significant reaction may occur there. In other words, the market may accelerate through those zones if bullish momentum is strong enough, or it may temporarily stall while participants reassess positioning. Either outcome would confirm that those price levels carry importance within the structure of the market. Time cycles provide another dimension to the analysis. Markets often experience periods where volatility expands suddenly after quiet phases. Certain cycle windows suggest that silver may encounter such volatility expansions during specific intervals. When momentum aligns with those windows, price movements can accelerate rapidly. If silver maintains upward strength during these cycle periods, the probability of a move toward the mid-$90 range increases significantly. On the other hand, if momentum weakens during those same windows, the market could experience temporary consolidation before resuming its broader trend. However, focusing only on bullish signals would create an incomplete picture. Every investment carries risk, and silver is no exception. Understanding the bearish case is just as important as recognizing the bullish thesis. One immediate risk comes from changes in margin requirements within futures markets. Exchanges periodically adjust the amount of capital traders must deposit to maintain leveraged positions. When volatility rises sharply, exchanges sometimes increase margin requirements to protect the stability of the clearing system. Recently, margin requirements for precious metals futures increased substantially. The cost to maintain a single silver contract rose dramatically compared with earlier levels. Such changes can trigger forced selling even when the long-term outlook remains positive. Traders who cannot supply the additional capital required by new margin rules must liquidate their positions automatically. This process can cause sharp price drops unrelated to underlying fundamentals. In extreme cases, the selling becomes self-reinforcing as falling prices trigger more margin calls, creating a cascade of liquidation. History has shown that silver is particularly sensitive to these dynamics because many participants trade the metal with leverage. Another risk arises from the sheer magnitude of the rally that has already occurred. A 170% increase within a single year represents an extraordinary move by historical standards. Markets rarely travel in straight lines indefinitely. Even during powerful bull markets, corrections often appear as investors lock in profits and new buyers wait for more attractive entry points. Historical precedents show that silver has experienced corrections of 20 to 30% even while the longer trend remained upward. A pullback of that magnitude could temporarily push prices back toward the mid-$60 or $70 range without damaging the broader structural thesis. Economic conditions also matter. If the global economy were to enter a severe recession triggered by energy shortages or financial instability, industrial demand for silver could slow temporarily. Solar installations might be delayed, electric vehicle sales could weaken, and manufacturing output would decline. Because industrial applications account for more than half of total silver demand, a major economic contraction would likely reduce consumption in the short term. A similar situation occurred during the financial crisis years ago, when silver prices collapsed despite strong long-term fundamentals. The market eventually recovered, but the interim decline demonstrated how powerful macro shocks can override even compelling supply and demand stories. Currency movements introduce another layer of uncertainty. Although the dollar has been weakening recently, currencies rarely move in one direction forever. A sudden geopolitical crisis, or an unexpected shift in monetary policy, could trigger a surge in demand for dollar-denominated assets. If the dollar strengthens sharply, commodities priced in dollars typically face downward pressure. Silver would not be immune to that dynamic. While such a development might not invalidate the broader bullish argument, it could delay further advances and create additional volatility. Technological innovation presents a subtler risk. Engineers constantly search for ways to reduce material costs in large-scale manufacturing. Over the past decade, solar panel manufacturers successfully reduced the amount of silver used in each cell by more than 70% through improvements in design and conductive paste formulations. At higher prices, the incentive to find alternatives increases even further. Researchers are experimenting with copper-based materials, aluminum conductors, and other substitutes that might reduce reliance on silver in the future. At the moment, none of those alternatives matches silver's conductivity and efficiency, but technological progress never stands still. Assuming that substitution will never occur would be a dangerous form of complacency. These risks deserve careful consideration because they remind us that markets can move unpredictably in the short term. Yet when analysts step back and weigh the evidence, the bullish side of the equation still carries substantial weight. 6 consecutive years of supply deficits have depleted stockpiles that accumulated over decades. Registered inventories available for delivery have fallen dramatically. Mining output has not expanded meaningfully even though prices have increased several-fold. At the same time, multiple industries are increasing their consumption of silver simultaneously. Solar energy expansion, artificial intelligence infrastructure, electric vehicles, and defense technology all require the metal in ways that are difficult to substitute quickly. The combination of shrinking supply and expanding demand creates the type of imbalance that often drives long-term price revaluations in commodity markets. When inventories approach critically low levels, the market eventually forces a repricing high enough to ration demand or encourage new production. That adjustment process can take time and it rarely unfolds smoothly, but history shows that it eventually occurs. Silver appears to be moving through exactly that kind of structural adjustment right now. Investors therefore face a complex environment. The long-term forces supporting higher prices appear strong, yet the path forward will likely include volatility, corrections, and sudden shifts in sentiment. Understanding both sides of the argument allows participants to prepare strategies rather than reacting emotionally when prices swing. The next step is examining the specific price levels and market signals that could determine where the silver market goes from here. With that broader context in mind, the most useful question becomes simple. What specific signals should investors and market observers be watching right now? Markets rarely move in a straight line. They move through levels, reactions, consolidations, and breakouts. Understanding where those key points exist can help determine whether momentum continues higher or whether the market pauses before the next phase of movement. One of the first important levels sits close to $88 per ounce. This zone represents the first major resistance area above the equilibrium range that developed after the market rebounded from the recent low near $78. If silver manages to close firmly above this region and hold it as support rather than resistance, it would confirm that the recovery from that sharp decline has real strength behind it. Markets often test these areas repeatedly before deciding which direction to follow. The next critical level lies around $91.63. This point represents more than just another round number. It marks the boundary where many technical frameworks suggest the market could transition from simple recovery into a broader expansion phase. When prices remain below that threshold, traders often interpret the movement as a rebound from an oversold condition. But once that level is broken and sustained, the market structure shifts. what previously acted as resistance may begin acting as support, and new higher targets become visible on the charts. Above that point, another zone emerges near $95 and slightly beyond. That area carries additional significance because several independent analytical models converge there. When multiple frameworks identify the same level, traders pay closer attention. Markets sometimes react strongly at these confluence points because many participants place orders around them. If silver were to reach that region and hold above it on a weekly basis, the technical outlook could shift from cautiously bullish to aggressively bullish. In that scenario, analysts would begin discussing the possibility of a move toward or even above $100 per ounce. While these upside levels attract attention, responsible analysis always includes the downside thresholds as well. The first important support sits near $83.80, which corresponds to the equilibrium level that previously balanced supply and demand in the market. If silver experiences a pullback but remains above that area, the broader upward momentum would likely remain intact. Temporary declines within that range would represent normal consolidation rather than structural weakness. However, if the market were to close decisively below that equilibrium level, it would suggest that momentum has stalled and that traders are reassessing positions. Below that point, the most critical support returns to the region around $78, where the recent recovery began. That level marked the extreme oversold condition from which the market rebounded strongly. If prices were to fall beneath that support, the entire recovery structure would become questionable, and the market might search for lower equilibrium zones. Such an outcome is not the primary expectation based on current data, but identifying the level remains essential because risk management depends on knowing where a thesis would be invalidated. In addition to price levels, certain timing patterns may influence volatility in the near term. Markets often experience bursts of activity during particular cycle windows when multiple trading systems respond simultaneously. During those periods, price movements can accelerate rapidly in either direction. If silver pushes through resistance while volatility expands, momentum traders may enter aggressively and amplify the move. Conversely, if volatility expands while the market sits near resistance, a quick pullback can occur as traders secure profits. Another variable worth monitoring closely is the behavior of the United States dollar. Because silver is priced internationally in dollars, significant currency movements can temporarily dominate price action. If the dollar continues weakening, international buyers effectively receive a discount when purchasing silver, which can support higher prices. But if the dollar unexpectedly strengthens due to geopolitical events or monetary policy changes, commodity markets often face short-term pressure. Observing currency trends alongside precious metals can therefore provide valuable context for understanding sudden shifts in momentum. Risk sentiment across broader financial markets also plays a role. Assets such as equities, cryptocurrencies, and commodities often move together when investors feel confident about economic growth. When risk appetite rises, capital flows into many markets simultaneously. When fear spreads, investors frequently retreat toward cash or government bonds. Monitoring these cross-market signals can help determine whether movements in silver reflect its own supply and demand dynamics, or whether they are part of a wider shift in investor psychology. Stepping back from short-term fluctuations reveals the larger transformation taking place within the silver market. What appears on price charts as a rally may actually represent a deeper repricing process. For decades, the price of silver was heavily influenced by paper trading within futures markets. Contracts representing large quantities of silver changed hands without requiring the physical metal to move. That system worked smoothly as long as inventories remained abundant and few participants demanded delivery. However, as industrial consumption increased and stockpiles began shrinking, the gap between paper pricing and physical availability gradually widened. Evidence of this disconnect has appeared in multiple places. Retail premiums in certain markets have surged far above the quoted futures price. Dealers in several regions have reported difficulty sourcing metal even when paper prices suggested ample supply. Meanwhile, inventories stored in major vault systems have declined dramatically. These signs suggest that the traditional pricing mechanism may be adjusting to reflect physical scarcity more accurately. When such adjustments occur in commodity markets, the transition can be abrupt because prices must rise high enough to balance supply with demand. Three central conclusions emerge from examining the entire landscape. First, the price level around $88 reflects more than speculative enthusiasm. It reflects 6 consecutive years in which global consumption exceeded production, steadily draining the reserves that once buffered the market. At the same time, powerful industrial sectors such as solar energy, artificial intelligence infrastructure, electric transportation, and defense technology are expanding their use of silver. A weakening dollar and accommodative financial conditions provide additional support. Together, these factors create the conditions for a long-term repricing toward what many analysts consider the metal's fundamental value, which some models estimate near $130 per ounce. Second, the technical structure of the market aligns with the fundamental story. Prices rebounded strongly from the $78 region, confirming that buyers viewed that level as a deep discount relative to underlying value. The market now trades above the equilibrium zone while approaching resistance clusters identified by multiple analytical frameworks. Breakouts above $91 and $95 would signal the possibility of further expansion toward triple-digit territory. At the same time, maintaining support above $83 remains essential for preserving the current bullish momentum. Third, the divide between physical supply and paper market pricing has reached unusually extreme levels. Inventories available for delivery have declined sharply, while premiums in several retail markets indicate that real metal often trades above the quoted futures price. Such divergences cannot persist indefinitely. Eventually, either paper prices rise to match physical scarcity, or demand collapses enough to restore balance. Current evidence suggests that scarcity is increasing rather than easing, which implies that higher prices may be the mechanism through which the market resolves the imbalance.